Good afternoon, ladies and gentlemen. Welcome to the Next 15 Communications Group PLC investor presentation for the results for the 6 months ended 31st of July 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted anytime via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Tim Dyson, CEO, and Peter Harris, CFO of Next 15 Communications Group PLC. Thank you.
Thank you. Hello, everybody. Tim Dyson, CEO of Next 15. Quite a lot to get covered today. I wanted to give you a brief introduction to the company and also summarize the results, walk you through the progress that we've made, give you some understanding of how we see the market and how that's affecting us, then sort of touch on our product strategy, segmental strategy, and an update on what we're doing from an ESG perspective before I hand you over to Peter, who can cover off the numbers in a bit more detail. Firstly, for those of you who are not familiar with Next 15, we are a tech and data-driven growth consultancy, which really means we sit really in the space that sits between the traditional marketing consultancy groups and the management consultancy groups. What we are particularly focused on is high growth organizations or growth companies that want to be high growth organizations. Our heritage in the B2B tech era has really helped us sort of create an organization that is exactly designed for that. We also just believe that it is a very interesting place to try and offer a set of products and services with the growth in technology-enabled services that we're seeing come to market at this time. Our business is spread into 4 different areas or segments. The first is in relation to insight, helping customers understand the problems that they face, the opportunities that sit in front of them, where their competition is succeeding and they're not, etc. Secondly is in customer engagement, which is really around building long-term relationships with our customers, typically through the development of digital assets. The third is in relation to customer delivery, really otherwise known as sales or sales engagement, which is making sure that the types of programs that companies are running typically from a marketing perspective are actually driving sales, because if they're not, then why are we doing it? The last area is business transformation, which is where we help companies really maximize the value of their business through a whole range of different things, helping them in some cases redesign those companies, create new ventures, but obviously maximizing their corporate positioning as well. Our customers include the great and the good of the technology industry, but also some pretty major corporations outside that. We are very global in nature, although the vast majority of our operations are in the UK and the US, and I'm based in California. In terms of a quick summary of our results, revenue up 23% organically, 32%. If you take into account also that FX was a bit of a headwind, it would have been even higher. Profits up a more impressive 65%, EPS up 51%. EPS up slightly slower than PBT, just really because of a higher tax charge, because more of our profits are coming out of the US, and in part because we also have some bigger minorities in this time, just because of the performance of some of our businesses that have bigger minorities, but still a very impressive performance. A very strong balance sheet, net cash on the balance sheet, certainly no net debt at this point. Big facilities, though, if we do need to go and do things. Having said that, the history of our company is not one where we do take on a lot of debt. The dividend here is the only number that really is a forward-looking indicator. This would be a 20% improvement. We didn't pay an interim dividend this time last year, but if we had, it would have been at 3p. So read into that we're actually very confident about the outlook of the company, but we also have uses for our cash. In terms of where we are growing, we continue to add good customers. The largest here is Boots, but some pretty good names there. certainly the largest financially for us is Boots. The vast majority of our growth, though, in this period has come from expanding the relationships we already have. We have a track record of keeping customers, but we also do have a very good track record of growing them. And it's certainly been more an area of focus in the last sort of 12, 18 months is to really try and not just expand them within the areas of business that we have historically done work with them, but take them into new areas as well. We do continue to acquire companies. We seem to acquire sort of roughly, 5 to 8 businesses per year. Certainly 6 seems like a fairly normal average. We did 3 investments in this period. I wouldn't be surprised if we do more in the second half. From a product perspective, this has been another big area of focus for us, and you saw us roll out a series of technology-related products that automate different aspects of the task that we do for customers and create a more self-service option for them. Again, you'll see more of that from us in the future. In terms of what we're gleaning from the market, I don't think there's any real huge surprises here. Virtually every customer is on some form of digital transformation journey. We are seeing more, customers shift towards buying based on subscription-based services, product-based pricing. That's in part because we're pushing it, but partly because also the market is waking up to that not being necessarily a bad way to operate. We also see that specialism does beat scale every time. Increasingly, where we are bidding for larger contracts, we're coming up against larger global organizations, but we're seeing that our deep sort of domain expertise certainly in areas in technology is proving very valuable in that regard. Product life cycles are rapidly increasing, which is actually a good thing for our business. Customer loyalty is being decimated with everybody shopping online. No real shock there, but it is changing the nature of the work that we do. The last point on here, work from anywhere, is very much the new norm, and is definitely helping us find new pools of talent. We have staff in the US in 30 states. Pre-pandemic, we only had them in 10. In the UK, we increasingly employ people outside of the London area, whereas historically, 95% plus of our employees were sort of within the M25, if you like. Whilst it's definitely a challenging market from a recruitment point of view, this sort of expanded view of where we can recruit from has helped us. In terms of product strategy and how that's sort of evolving as we evolve as an organization, where we currently do a lot of our work is where you would describe it as custom. In other words, it's in some way derived by how much time did that task take, and therefore it's sort of a build by the hour notion of pricing. Over 50% of our revenues come from that type of work at this point. We're long-term looking to really shift that away from that to a more packaged and what we're describing as a tapas solution, so technology and people as a service, with a small percentage also, though, being firmly in the SaaS bucket. We think there are a number of benefits if we can make this transition. One being that we sort of move ourselves away from certain dependencies on key individuals or for the availability of key individuals at certain times. We also think it leads to a more profitable profile for the business. We're selling IP as opposed to selling hours. We also just think it's an infinitely more scalable business in lots of different ways. In terms of how the insights that I talked about earlier are impacting our world and how this product strategy is shaping up things, we are seeing substantial growth in our business transformation services. Companies are really coming to us with some fascinating innovation challenges. We're seeing large-scale growth in anything to do with D2C and industrial e-commerce. We're seeing, as I've mentioned, this shift away from hourly-based pricing towards other ways of pricing. The volatility that we have seen in some areas of our business due to shortages of staff, as if anything, only increased that desire to move towards a more product-based approach. In terms of how the individual segments have performed, what you've seen here is very good growth across all of the segments, but obviously the segments on the right of delivery and transform have been really quite stunning. We don't see that type of growth slowing. It may slow a little bit, just simply as those businesses scale. But both of those areas of business have got way more opportunity in front of them than they can typically handle. The inside business has also been showing very good growth. Its margins were a little softened this period just simply because of some investments that we made. We expect that to bounce back up to the 20% level we already have in this particular quarter, and I expect next year them to be solidly around 20%. Engage has been a very good area for business. It's where the sort of the older area of our business came from, but it has had a pretty good performance in this period. I think that growth will moderate into next year. It is doing better than I think we would normally expect in these conditions, but its margins I think will remain very much where they are. Looking at each of those segments and sort of trying to give you an understanding of how big those businesses could be, and also sort of where our focus is within each of these segments, you can see in Insight, the future really lies by us driving product sales. Just one of these products could become quite easily a £20 million business for us, sort of roughly the size of the whole division for this 6-month period. But we have quite a number of self-service products that are coming to market in the next sort of 12 to 18 months. So I think we should still see some pretty substantial growth. The growth will also really accelerate in the US. That business is roughly a $20 million business at this stage. We're looking to get that up to sort of north of 50 million by 2025. Very much a first-party data business, though. If any of you have concerns about third-party cookies, do not be worried. That's not the business that we're in. If I look now at the Engage area, this, as I've mentioned, is the more traditional area of our business. It is the most hourly billed area of our business. If we can shift more of our revenues into packaged and tapas, that will inevitably help us to drive better growth. I think margins could also nudge up a tiny amount as well. It is the area where we could build our first $100 million individual business through Mbooth, and they're certainly well on track for that. In delivery, where we've probably seen some of our strongest growth, there is scope to build 3 pretty large businesses. The first in ABM, account-based marketing. We're seeing huge opportunities and lots of growth in that area. Industrial commerce or e-commerce in general is a rapidly expanding part of our business, in part through acquisition, but also through organic. The emergence of composable commerce, which is essentially, rather than relying on a particular platform like Magento or Shopify or Adobe, you're able to literally sort of plug and play a whole bunch of different areas of technology to create e-commerce solutions for customers. We think will drive another level of growth in the mid-market, and we're certainly excited to see that happen. The last area of growth for us is really around demand gen or lead gen. That has been a very high growth area of our business particularly in this period, but certainly over the last 18 months to 2 years. We don't see that slowing down, and that could easily add another $100 million revenue business alongside that. In terms of the last of our areas, transform, we said a while ago that we wanted to build a business in the $100 million range. We were a little slow in actually finding the right ways to do that, but with Mach49 and Palladium in particular, we're making remarkably good progress. That'll be certainly over a £40 million business this year, and with very high growth, I think we may actually beat that target if things continue. If anything, the only real thing that we need to focus on in this space is making sure that we take full advantage of the relationships that we're building with major corporations. If we can, then this business will not only generate high growth as a segment, but will drive growth across the other segments. In terms of an update on ESG, this is a hugely important area for us as a business, not just because we know that it's an area of interest for our shareholders, but to be honest, it's an area of massive interest for our employees and for our customers. In fact, customers like Google pay an enormous amount of attention to things like what our diversity, equity and inclusion programs are and what our metrics are, and even look at the output of our work in relation to that and make sure that not only have we got a diverse workforce, but that the work that they are producing on Google's behalf is equally diverse. In terms of carbon footprint, we're not just measuring the footprint of our operations, in terms of travel, the facilities that we operate around the world, etc., but we're also looking at the impact our work has on carbon footprint. So even down to things like which products we choose to help our clients promote, the packaging of that product, the efficiency of any technology. If it was a car, for example, we work with Toyota and Honda in different ways. Are we promoting their more clean energy products, or are we promoting their traditional combustion engine products? Obviously, if we choose the clean energy ones, then we will increase the sales of those more, and therefore that will have a better impact on the climate. And very often it's sometimes left to us as to which of those products appears in a piece of digital content, for example. Lastly, on that slide, we do have an ethics group that looks very closely at who we work with. If we are to become a B Corp, then that is a requirement. And we have let go a number of clients because they don't meet our ethics standards or value standards, or have simply chosen not to work with people who've approached us. And that will be a feature going forward. The good news is it's clearly not hurting our ability to grow. And ironically, if anything, within B Corp, you get points for working with other B Corp companies. So at a certain level, we hope to also see revenue come just by virtue of being a B Corp. At that point, I'm going to hand over to Peter, and he can walk you through the financials in detail.
Thank you, Tim. I think you've covered off quite a few of the points I was going to make, but obviously it's been a pretty stunning performance for us with total revenue up 32%. We had a record margin of 21.1%, which is obviously over 400 basis points more than last year. I think there's sort of a couple of reasons for that. One, we've actually had very strong revenue growth to our high margin businesses, particularly in that delivery segment. So we have a couple of businesses where the drop through of revenue to profit is above 75% because it's very much sort of technology and product based rather than people based. And we see that continuing. And also we have benefited from some COVID related savings, particularly around property, where we're very focused in London, New York and San Francisco. And we had quite a big review 3 months into COVID when we realised that people wouldn't be going back to the office in a similar sort of way. We ended up taking 5 million out of our property cost base, which, when your revenues, say 350 million or where it'll be this year, obviously that's had quite a big margin impact. Going forward, we think the scope to, further increase in margins as we have more growth to our high margin sort of businesses and segments, but also I think there's more economies of scale, particularly in some of our back office areas like property, where I think there's probably more to come. So I think you should see us sort of continuing to increase our margin, maybe not quite at the rate because of the sort of I think the pandemic did have a step change in our margin, but we think there's sort of further to come. Our tax rate last 6 months was 22%, which is slightly higher. I think Tim mentioned that we having a higher proportion of our revenue and profit coming out of the US and tax rates there are slightly higher. Also, minorities, we have a couple of our very fast growing businesses where management still own quite a big slug of the equity, and so that minority has increased quite materially. But we've had quite a nice increase in dividend. I think you shouldn't view us as a dividend stock per se or income stock per se, but we think it's good discipline on the business to pay a dividend, and it is a sign of confidence in the future. In terms of a revenue bridge, if we hadn't had a strengthening of sterling in the 6-month period, we would have grown our revenues at 40%. I think we have an aspiration to double the size of the group every 3 years. So of course that 40%, it is above average. But certainly going into our second half, we're not seeing any slowdown, and we've got quite a good pipeline of M&A. In terms of details, our by segment, the customer insights, Tim described what it is. I mean, really should think of it as more of a YouGov challenger brand. We acquired this business 5 years ago when it was literally sort of 1 million in revenue, and through a series of acquisitions plus fairly strong organic growth, it's turned now into 40 million revenue business. So all 40 million run rates with sort of 4 years of some recent acquisitions. The margin should be capable of getting 20%, which I think is a benefit of scale, but also as some of the investments they're made in their platform and technology sort of work their way through. And so I'd like to think that organic growth-wise should be in the sort of 15% plus range once we sort of get into a sort of post-pandemic world. Customer engage, we have a lot of the key client relationships there. So Google, Facebook, Amazon relationships started there and have migrated into other segments. So it's still a critical part of the group, albeit it'll probably grow at a slightly slower rate in the other segments, but very well run businesses above industry margins. 22% is a great margin for a sort of people-based business. And I think our challenge is to really get more technology, more products into that segment, and less dependency on people. Delivery has been an incredible sort of growth story for us in the last sort of 12, 18 months, and I can see that continuing. It's the highest margin business. So if you've got your highest growth segment being also your high margin business, then obviously that should lead to a very good future for the next sort of 12 months and beyond. And business transformation is our newest segment. We didn't really have anything in that segment 18 months ago, and as you can see here, some very strong growth, and we think that's going to continue. On cash flow, it was another strong period for cash generation. We had a very strong working capital inflow last year, which was partly because the government really helped all companies in that initial stage of the pandemic. So we deferred a lot of VAT, and actually we used the furlough scheme quite a bit. All of that's now unwound. So VAT we've normalised, and also we repaid the furlough money because we actually performed a lot better than expected, and we thought it was an appropriate thing to do. So I think for some of that 9.2 million working capital outflow is a sort of unwind of an amazing performance this time last year. CapEx is relatively small for us. We do invest in property, not so much these days, and also some sort of software products. Our biggest cash outflow, as you can see, is on acquisitions, and I think that'll continue at a similar rate. But as you can see, we've got net cash at the end of July, and together with 100 million facility, we've actually got a lot of headroom and ability to make acquisitions. Final slide for me. The way we tend to do acquisitions is that we effectively buy a business. We value it on acquisition, but only pay for 50% upfront, and then we lock management in over the next 5 years through an earn-out where they can hopefully earn a lot more over that 5-year period as the business grows. So we typically have maybe 1 year's worth of profit in potential future capital payments. Now that we have to do that calculation every 6 months, to fit in with our reporting cycle, and we tend to be fairly aggressive in terms of our expectations of businesses. And if you were to look at our analyst forecasts, they've actually been much more modest in terms of our expectations. So all of these payments here are based on very aggressive assumptions for growth, and typically sort of 15 to 20% per annum, which is above what the markets expect us. So these are all very sort of fundable and probably more on the aggressive side of life. So on that, I'll hand you over to Tim.
Yeah, I mean, in terms of outlook, we don't really see the business changing that dramatically. Certainly this quarter, we're seeing the performance very much continue from where it left off in Q1 and Q2. We are seeing a very strong acquisition pipeline, and I think we'll continue to do that. We don't tend to approach acquisitions in the sense of we want to acquire a certain amount of revenue, that type of thing. And I did notice a question come through on the Q&A about, in terms of other gaps we're looking to specifically fill. I think there are some gaps in our insight business that, some of them are geography, some of them are vertical markets, and you'll see us just continue to sort of edge away at those sorts of gaps. And this, to some degree, you could apply a similar strategy for the other areas. But in particular, in customer delivery, I think we see so much opportunity there that it's really just further investments in a whole set of products that fit into that particular space. For Engage, we have a job to do to digitalize, or whatever the right word would be for that particular area of the business. The investments there will be much, much smaller relative to the other areas. In terms of product progress, you'll see us continue to just invest. If our margins don't radically improve in the next 2 years, I won't be surprised, even though it's clear that higher margins are coming out of higher growth areas of our business, and that ought to drive higher margins in the short term. I think we're just simply going to reinvest that margin gain, if you like, in more products, so that we drive actually more high long-term growth for the business. And once that starts to unwind a bit, it will also then just yield even higher margins for the group on an overall basis. Operationally, we are still running the business very, very tightly. The hybrid working model is definitely creating a benefit from our perspective, in terms of, we have seen this step change in office costs, a step down being in office costs, and I don't see that reversing. If anything, it could actually continue to improve. But I think you will see some modest return to costs in H2 as a little bit more travel happens, as a little bit more in-person work in the office happens as well, but nothing that material. At that point, I'll sort of dive into any additional questions that people have.
Fantastic, Tim Peter. Thank you very much for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard and the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Tim Peter, as you said, Tim, we've had a number of questions through, some of which you picked up on already in the presentation. But if I may just hand back to you to read out the question where appropriate to do so and give you a response, please.
Sure. So one of the first questions was, how much of our business is repeat and how much of our business is moving to TAPAS and SaaS. What I'd probably do is refer back to that slide that had the product strategy on it. Just quickly try to get us there. Sorry, just to navigate this a little slowly. Here we are. Oh, sorry, not too far. The numbers in the middle of those shapes are what we're trying to get to, is essentially only around 10% coming out of Build by the Hour, roughly 50% being product pricing, the remainder, in TAPAS and SaaS. We don't ever think that we'll be a pure SaaS player in real massive scale. Just under 3% of our revenues comes from SaaS at the moment. A much higher percent already comes from TAPAS, and certainly in areas like customer delivery, it's a very big proportion of our revenues. So to some degree, the shift will happen just by the natural growth of the higher growth areas of our current business. As they become a bigger share, the fact that so much of their revenue comes from these areas will just naturally shift our revenues in that direction. But I think the biggest opportunity for us is to take areas such as Engage, which at this point is virtually all in the custom area, when it's, in other words, it's related to Build by the Hour work, and shift as much as we can of that into certainly at least the packaged area, if not the TAPAS area. So I think you'll see us undergo kind of one of those kind of like, hopefully the swan gliding across the lake, where it looks relatively calm, but an awful lot is going on underneath. but it is one of these where the opportunity is ours. We're not really seeing any resistance from customers. It's simply a question of, can we get the work done? Can we put all the work that we do into a form that works from a product perspective? Can we price it right, and so on? In terms of other questions, what's the competition like for acquisitions, and are valuations realistic? We have seen some slight edging up in some areas on acquisitions. Private equity will always compete in our space and will always offer much, much higher initial consideration multiples than we will. And we're quite happy to let them win those if they want to. We just simply don't want to get into a place where we are loading the company up with lots of debt that is very risky in our minds. We would much rather have a deal structure where, essentially we reward people very well if their business grows and is delivering good margins. If it is, we're very happy to pay them good multiples on the back end, but those tend to be relatively self-funding deals. So the only part of the deal that, if you want to call it out of pocket on in the short term, is the initial consideration. So you'll always see us try and keep that much more modest than a PE house would. We typically, I think the highest we would go in initial consideration is probably on a 9x multiple, and that would have to be for a very digital, very high growth, high margin business. And that's probably up from a multiple that we may have paid pre-pandemic, somewhere like 7.5, 8. So not a huge inflation on that multiple, and certainly not problematic when it comes in relation to our own multiple. What we haven't seen is inflation on the back end, where we use a matrix typically to of multiples that it relates to the growth and the profitability of the business. I think if we saw inflation there, that would be more concerning. In terms of competition for acquisitions, it's never been uncompetitive, but I don't think it has become more competitive. The last of the questions that I can see here is, could you give a geographical breakdown? I think that's what Peter is trying to navigate to as I speak. Here we go. So, what this shows you is, we actually deliver good margins across pretty much all of our segments. APAC does tend to be the weaker from that perspective. It's also, though, the most geographically diverse. In some ways, APAC is a bit of a misnomer when it comes to being a region. It's so geographically spread out, and so you don't quite get the same efficiencies that you do with markets that are on much narrower geographic footprints and time zones and the rest of it. But having said that, it's been a very reliable area for us from a business perspective. The growth has also been pretty solid, very comparable, obviously, to mainland Europe. But the bulk of our business clearly still comes from the UK and the US, and certainly during this period, the type of growth that we're delivering in the UK and the US and the margins that we're delivering in those markets are clearly much stronger. The US has always been a higher margin area of our business. You just get tremendous economies of scale in that market, and therefore I don't see that changing.
That's fantastic. I think, Tim, Peter, you've covered off all the questions we've had through, and if any further questions do come through from investors, of course, you will be able to review those and we can publish responses where appropriate to do so. Tim, perhaps I could just ask to get a closing snapshot from you before we redirect the investors to give you some feedback, please.
Hopefully what you've picked up from the presentation today is that, our business is increasingly product-driven, data-driven, tech-driven. That was a direction of travel pre-pandemic, but it has clearly accelerated as we've worked through the last 12 to 18 months. I feel very confident about the outlook for the business. Our customer base remains incredibly high quality. They are companies that are trying to grow if they are not already growing very rapidly. That naturally creates tremendous opportunities for a business like ours. if anything, really the only challenge that we're facing is making sure that we execute well. I think if we do execute well, then we'll continue to deliver very strong performance in the next year or two without really much of a headwind.
That's fantastic. Tim, Peter, thank you indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order the management team can better understand their views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Next 15 Communications Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you.